So let me guess, you got caught going long or buying call options at all-time highs, only for the market to sell off, leaving you significantly down on your position. Don't worry, it happens to the best of us. But here's the thing, more often than not, there was a warning sign before the drop happened. I can almost guarantee that if you go back and look at the chart, you'll probably find a hammer or an outside bar at the top of the trend, signaling a potential reversal. So in this video, I'll show you exactly how to spot these signals so you don't get trapped again. So let's break it down. So when the market is at all-time highs or at the top of a broadening formation, there are two key candlestick patterns to watch out for: hammers or inverted shooters and outside bars. Both of these patterns can signal a shift from bullish to bearish momentum, giving you a heads up before the market turns. Let's start with the hammer. A hammer is a candlestick with a small body at the top and a long lower wick, meaning that price dropped significantly during the session but recovered at the close. Now at the bottom of a trend, this can be bullish signal indicating that sellers tried to push the price lower but failed. However, at the top of an uptrend, or at the top of a broadening formation, a hammer often signals a bearish reversal. Now, why is that? Well, this is because in an uptrend, buyers have been in control, consistently making higher highs and higher lows. But when a hammer forms at the top, this tells a different story. It shows that sellers stepped in aggressively, driving the price down, and buyers attempted to recover by the close. The long lower wick also reveals that selling pressure is increasing, potentially shaking out weak hands. Now, if the next candle breaks below the hammer's low, trapped buyers might be forced to sell, which accelerates the reversal. Now, let's talk about outside bars. An outside bar at the top of an uptrend or a broadening formation can be another major warning sign. Now, this pattern occurs when the current candle's high is higher than the previous candle's high, and its low is also lower than the previous candle's low, completely engulfing the prior price action. Now, this often signals that market makers are trapping breakout traders, pushing price slightly above previous highs to lure in buyers before reversing downward. And when this happens, it's a sign that institutions or large traders may be offloading their positions. Now, if the next candle breaks below the outside bar's low, it confirms a shift from bullish to bearish control. Now, here's something critical to understand. These signals may not always appear on the daily chart. Sometimes they'll show up on the 2-day, the 3-day, or even the weekly time frame, which is why multi-time frame analysis is so essential. So for example, in the most recent sell-off, I warned my mentees to be cautious about going long at all-time highs. If we go to the 2-day chart, because we know that opens up tomorrow, you are still a hammer at the top of the broadening formation. So I'm still going to be cautious just in case there's going to be a downside move. Why? Well, because if you look at SPY on the 2-day chart, you see that we had a green hammer after putting in or making a new all-time high. Now, at this point, if you're a stratter, you know that you're facing broadening formation exhaustion at this point. And not only that, we see that we have a look above, a hammer, and we got the 2-2 reversal to the downside. Now, this hammer right here, at least for me, told me to be cautious about going long just in case they actually want to put in a reversal signal. This was not the only indicator telling me to be cautious about going long. If you had looked at ES on the 2-day chart, you would see that we put in an outside bar at the top of the broadening formation after making a new all-time high. Well, what happened afterwards? You can see we got the 3-2 down on the 2-day chart. So in both of these examples, it wasn't necessarily the daily chart telling us to be cautious, but we found it on a different time frame, such as the 2-day chart. And sure enough, the hammer on SPY on the 2-day and ES on the 3-day signaled the sell-off perfectly. Another example was actually back in December when I went short DIA. If you look at DIA on the 2-day chart, it gave us the exact same setup. We had an outside bar plus a hammer at the top of the broadening formation after making a new all-time high. And you see what happened afterwards? You can see that we got this amazing sell-off following this 3-1-2 to the downside. If you go back and study previous market sell-offs at all-time highs, you'll notice a clear pattern. Before the drop, there was often a hammer or an outside bar on a larger time frame. You just had to know what time frame to look for. Now, will a hammer or an outside bar appear every single time before a sell-off? No, of course not. But as traders, we focus on trading repeatable setups that put probability in our favor. and this is one of them. So here's a key takeaway. When a hammer or an outside bar appears at the top of an uptrend or broadening formation, it could potentially signal buyer exhaustion, increased selling pressure, and a higher probability of a bearish reversal if the low breaks. And don't just take my word for it. Go to TradingView, pull up a chart, and look at the past sell-offs at all-time highs, and check different time frames. Did a hammer or an outside bar show up before the drop? Let me know in the comments. And if you found this video helpful, make sure to hit that subscribe button, like the video, and drop a comment below with any questions. I'll see you in the next one. Peace out.